Today we will discuss about the credit creation process of commercial banks. We know that one of the important peculiar feature of a banking institution is the capacity to create from their deposit. This credit creation process can be explained as loan creates deposits and deposits creates loans. This is the process of credit creation, or from the deposits loans are created, and from the loans the deposits are created. What is the process of this credit creation are explained in the following sections. One of the important peculiarity of the banking financial institution is that their ability to create credit, that is expand their demand deposit as a multiple of their cash reserve ratio. Cash reserves, that is this is the process of credit creation, the capacity of a bank to expand their demand deposit as a multiple of their cash reserves. This is because of the fact that demand deposits of the bank serve as a principal medium of exchange, and in this way the bank manages the payment system of the country. That is, the demand deposit of the bank serve as the principal medium of exchange in this regard. The multiple expansion of deposit is also called the credit creation. Multiple expansion of deposit is called the credit creation. When a bank extends loans, it is not only directly paid to the borrower, but is only credited to his account, and a checkbook is given. That is, when a loan is given to a customer or borrower, it is credited to his account and a checkbook is given, or it is given in the form of the deposits by the bank. Thus, every bank loan creates an equivalent amount of derivative deposit. The deposit that created by in that way, or the deposit created in this way, is known as the derivative deposit. By using this deposit, the bank can again extend loan to some other parties after keeping a specified amount as reserves. By using this derivative deposit, or on the basis of these derivative deposits, other bank can provide loans to other parties. This is the process of credit creation. Thus, with a little cash in hand, the bank can create additional purchasing power to a considerable degree. Credit can be created by a single bank or more than one bank. That is, credit creation process can be by a single bank. That is, the process can be within the bank, or it can be extended to the banks outside or for more than one bank, or to the banking system as a whole. When it is created by more than one banker, it is called the multiple credit creation, and if it is created by single bank, it is known as single credit creation. That is, here the credit creation process is with a little deposit or with a small amount of the deposit, the government the bank can provide loans, and when a bank provides loans to a customer, it is deposited into his account. These deposits by the banks are known as derivative deposit, and then on the basis of this derivative deposit, the bank can provide loans to some other customers also. This is the process of credit creation, and it is some of the terms connected with the credit creation process. Bank deposit form the basis of the credit creation, and it is of the two types. Primary deposit: a bank accept cash from the customer and open a deposit in his name. This is the primary deposit. And second, there is a secondary deposit or derivative deposit. There is another form of the deposit also in the case of the credit creation. It is known as secondary or derivative deposit. A bank grant loans and advances, and instead of giving cash to the borrower, opens a deposit account in his name. This is the secondary or the derivative deposit. The bank opens an account, and the bank deposits that loan amount in his account. That deposited amount is known as derivative account. We all know that when a bank sanction a loan, a separate loan account will be created, and the bank will deposit that amount, or will deposit the amount into that account. We can withdraw on a lump sum, or by the can withdraw in accordance with their convenience also. These types of the deposits created by banks are known as derivative deposit, and on the basis of this derivative deposits, the bank creates loans or gives loans to the another customer. This process will go on. This is the primary deposit. This is the difference between the primary deposit and the secondary or derivative deposit. And then another term associated with the credit creation process is the cash reserve ratio. It is on the cash reserve ratio that determines the extent of credit creation by a bank. That is, cash reserve ratio is the percentage of total deposit which a bank must hold in cash reserve for meeting the depositors' demand cash. That is, this is the amount of deposit to be kept in the form of the cash by the bank. And another term is excess reserve. Excess reserve means reserve over and above the cash reserves, or the excess. That is, the total deposit by minus the cash reserves are known as the excess reserve. That is, there will be a total deposit amount. From that, the bank have to keep a certain portion as cash. This is known as cash reserve, and the difference between the total deposit and cash reserves are known as the excess reserves. And another term is credit multiplier. Given a certain amount of cash, a bank can create multiple times of credit. In the process of multiple credit creation, the total amount of derivative deposit that a bank creates is a multiple of initial cash reserve. That is, it is a multiple of the cash reserve. This credit multiplier is an important. Credit multiplier is nothing but the 1 by CRR in percentage terms. 1 by CRR is the 1 by CRR is the credit multiplier. Then this multiplier can be used for finding out the total amount of the deposits as well as the cash total amount of the derivative deposit, etc. This credit multiplier is 1 by CRR percentage. If CRR is 5%, then the credit multiplier is 1 by 5%, that equal to 20. Credit multiplier is 20, and if CRR 10, if it increases, credit multiplier will be lower and lower. This is the next term. So for some of the important terms that we want to some of the terms that we use in credit creation process of deposit. There are two types of the deposit: primary deposit, derivative deposit. Then another term associated with this cash reserve ratio, then excess reserve, then credit multiplier. These are the terms associated with the credit creation process. And the credit creation process can be analyzed in two ways: the credit creation process by a single bank and credit creation process by a multiple bank. There are two ways of analyzing the credit creation process: credit creation by a single bank and credit creation by a multiple banking system. Now let us see what is the process. Suppose, imagine that CRR maintained by bank is 20%. That is, 20% means out of 100 rupee they have to keep 20 rupee as cash. That is the CRR. Then the other amount can be given for the given as loans. Then the credit multiplier is 1 by 20%, that is equal to 5. Suppose now a deposit rupees 10,000 with the SBI. The initial deposit is 10,000. The bank needs to keep the entire need not keep the entire amount as a reserve. After keeping their cash reserve, they can use the rest of the amount as loan for giving loans to the customer. That is, after keeping 20% of 10,000, that is 2,000 in hand, bank extend a credit of 8,000 initial excess. This 8,000 is known as initial excess reserve. Then this 8,000 can be given as a loans to the Mr. B, and the loan will be sanctioned by the bank, and this amount will be deposited in B's account. This account is the loan account. The amount deposited by the bank is known as the derivative deposit. And this creates another derivative deposits of 8,000. That bank creates a derivative deposit of 8,000 by keeping 20% of this derivative deposit. That is 8,000 into 20%. That is 1,600 of this bank, of this amount in cash. The rest can be given to somebody else as a loan. That is, after keeping 20% of 8,000, that is 1,600, 6,400 can be given as a loan to C. And in the same way, he deposits the amount with the bank, or he can deposit with another bank in their places. And this process will go on. If it is within the single bank, then it is known as single credit creation. If it is extended to the banks outside this branch, then it is known as bank. Outside this bank, then it is known as multiple credit creation. Then the credit creation process can be explained. The credit creation process like this that we have explained. The credit creation process that we have explained so far is like this: A, deposit 10,000, cash reserve is 20%. Then after keeping 2,000 as cash reserve, bank sanction loan of 8,000 to the B. Then this 8,000 is sanctioned as a loan to the B in a separate account. Then by creating separate account, the bank is creating a derivative deposit. After keeping 20% of this derivative deposit, bank can extend loan to the somebody else. That is, after keeping 20% of 8,000, that is 1,600, the bank can keep the rest of the amount, that is 6,400, as loan to somebody else. This process will continue, but how much the bank can create as credit is given in the following section. That is, the process continues until the initial primary deposit of 10,000 with SBI leads to the creation of total deposit. Total deposit is primary and derivative deposit of 50,000. Or initial excess reserves of 80,000 creates a total derivative deposit of 40,000. How we go to this 50,000 and 40,000? That is, with an initial deposit of 10,000 and cash reserve 20%, we can create a total deposit of 50,000 or a derivative deposit of 40,000. How this total deposit can be calculated is given here. Total deposit means initial deposit into the credit multiplier. Initial deposit is 10,000 and credit multiplier is 1 by CRR, that is 1 by 20% is 5, that is 50%, 50,000. Or total derivative deposit is initial excess reserve. The initial excess reserve is 8,000 into credit multiplier, that is 8,000 into 5 is 40,000. Then total deposit is primary deposit plus the derivative deposit at 10,000 plus 40,000, 50,000. This is the we can calculate the total credit creation process. If the total derivative deposits and initial excess reserves are given, we can find out the credit multiplier as 40,000 is the total derivative deposit, initial excess reserves is 80,000, 40,000 by 8,000 is the 1 by 20% or the 5 is the credit multiplier. This is the process of here total deposit equal to the initial deposit into credit multiplier. This is the role of credit multiplier. And total derivative deposit a bank can create with this 10,000 rupee and 20% of cash reserve is equal to initial excess reserve into credit multiplier, that is 8,000 in 5, that is 40,000. Then total equal to 50,000. Lower the CRR, higher will be the credit creation process. Or higher the CRR, the lesser will be the credit creation. That we will explain later. And here, suppose the cash reserve is 10,000. Then credit creation process by a single bank is explained. Suppose a deposit rupees 1,000 in a bank. Then cash reserve is 10%. That is, out of 1,000 rupee, he has to keep 100 as reserve. Then initial excess reserve is 900. This 9,000 can be given as in the form of loan to second B or another person, say B. Bank sanction loans to B and the amount is deposited in his account. This is known as derivative deposit. Then after keeping 10% of this 900, that is 90 rupee, the rest of 810 can be given as loan to the third person. After keeping the cash reserve of 81%, this 729 can, this process will continue, and the total amount that the bank can create equal to, in this case, the credit multiplier, if 10% is the cash reserve ratio, the credit multiplier is 10. Then 1,000 into 10 equal to 10,000, and the derivative deposit equal to total derivative deposit that we can create equal to initial excess reserve into credit multiplier. Here credit multiplier is 10%, 1 by CRR equal to 1 by CRR is 1 by 10%, that is 900 into 10 is 9,000. The total deposit that we can create is equal to 19,000. The second type is multiple credit creation by the banking system. That is, we can extend it to the banking system as a whole. Suppose a deposit rupees 10 rupees 1000 with SBI, and the cash reserve ratio is 20%, that is credit multiplier is 5. Then after keeping 200 as cash, the 800 can be given to B as a loan. Then suppose B deposit this amount with the Catholic Syrian Bank. Then their primary deposit is 800 and the cash reserve ratio is 20%. Then after keeping 160 with the bank CSB, extend loan of 640 to C. Then suppose C deposit this amount with Punjab National Bank. Then 640 is deposited with Punjab National Bank. Then after keeping the reserve, the Punjab National Bank can give loan of 512 to the another person. This is the process. This process of credit creation in the banking system as a whole is known as multiple credit creation process. And the factor determining this credit creation process, it is not it is not possible to create the credit as we have shown. It depends upon so many other factors like banking habits of the people, cash reserve ratio that we have seen. If they higher the ratio, the lower will be the credit creation process. If lower the ratio, higher will be the credit creation amount, etc. Monetary policy determines this cash reserve, etc. and all the reserves. These are the factors. These are the factors which determines the credit creation process of a bank. And here, the credit creation process with the different credit cash reserve ratios are given, and they here the credit, if cash reserve ratio is 5, then credit multiplier is 20. Then total deposit with the 10,000, then the total deposit, then the bank can create a deposit of the total primary deposit of 20,000 and derivative deposit of 9,005 into 20, that is 19,000. This much of the loans can be here. The amount will be higher as the CRR is lower. If CRR increases, the amount of credit creation total deposit will decrease. That means of the amount the bank need to keep with them, the rest only they can provide as loan. Therefore, the amount will be lower. This is the process of credit creation by the bank. That is, depending upon the cash reserves, the bank can increase their credit creation process with a small amount of initial deposit. This peculiar feature of bank is known as the credit creation process of a bank.